Good afternoon. It's still morning, I guess, 11 o'clock. I want to thank FIU. My name is Paul Cauchi. I'm the Chief of Commercial at Miami Realtors, and very excited to be here with Dr. Beracha and FIU. I want to thank Isabel and Carlos at the school for helping to put this together. An incredible amount of attendees. We're in the hundreds here, so it's really great to see so many people come out. Obviously, it's the strength of FIU and the strength of these incredible speakers and presenters today, like Adam, Alexandra, Wesley, and Jonathan. I want to just mention a few things about our association, if you're not familiar. Miami Realtors has 48,000 members total. We're the largest in the United States local association, second largest in the world to Toronto's association. And we have almost 3,000 commercial members now. We have some specific commercial tools that we have for marketing, for prospecting, and we're constantly adding new tools. So we've been partners with FIU for many years now, independently ranked the #1 real estate school in the country. So it's really exciting to work with them, to have them in our own community, in our own backyard. For those of you that are going to school there, you know how great of a campus it is and how great of a university it is. For those that are not taking classes now, you can speak to the team here about enrolling in some classes, including getting your master's in real estate. I also want to recognize Eileen Cardell, who is helping me a lot with commercial. She has a long background, and she's on the meeting today as well. And she is the manager of our Coral Gables office. So without further ado, just one more housekeeping thing is that you're all on mute, but we will at the end have time for questions. And our gracious host, Carlos Amaya, is going to be unmuting you if you do have a question. So just put your question in the question and answer, and then you can be included there, and we will have time at the end. We have some incredible presentations. We want to make sure we hear from all of them, but we do want to hear from you as well. So again, thank you, Paul Cauchi, Chief of Commercial at Miami Realtors. And let's hand it over to Dr. Beracha, who's going to introduce our first speaker and say a few words. Thank you.
Thank you, Paul. I really appreciate the warm introduction. So yes, I'm very grateful for the collaboration between FIU and Miami Realtors. Paul has been collaborating with us for some time now. And now if everything is going on, we do things remotely through webinars, and we keep informing the community. For those that don't know me, I'm assuming most of you do, but maybe some do not. I'm Eli Beracha. I'm the director of the Hollo School of Real Estate, and I'm also a professor in the program. At FIU, we offer both undergraduate degree in real estate and a graduate degree in real estate. For those of you that may be interested, we are the #1 school in the country in terms of research productivity, #2 in the world. We have 5 and soon to be 6 full-time PhD professors teaching only in a program that all have practical experience as well as academic experience. Again, more than any other school in the United States. We also offer 10 independent courses in real estate, which is something that is unheard of. I do not know of any other university that have the capacity to offer so many independent real estate courses. And this year we are on track to graduate about 100 graduates from our master's degree. All of them are basically being jumpstart in terms of their career and probably getting to where they want to be a lot faster than they would otherwise. I'm not going to talk too much about our program, but maybe I will give just 1 minute to Federico, that if any of you attendees are interested in our program, you can contact Federico, who is our official recruiter, but he's basically with our program, and he can answer questions. He'll provide his email and answer anything that you have. And then we'll start with the speaker. So Federico, if you can do it very short, I would appreciate it. Thank you so much.
Sure, Dr. B. Thank you for handing over. Thank you for having me at MAR. I appreciate it. Hopefully everyone's safe and staying well. Just to keep it short on the webinar, we do offer a Master's of Science International Real Estate program. We offer it both face-to-face in our Brickell location, and we also offer it online. As you know how things are right now, we are offering the spring enrollment, which starts in January, and hopefully by then things would be a lot more different. But yes, our program is a 10-month program, just like Dr. B said, it's 10 courses. We cater specifically to individuals who want to be executives in domestic and international commercial real estate with investment development, analytics, and investment properties. So yes, we have an enrollment now for the spring, which starts in January. So if you like, I'd be more than happy to put my email if you'd like to apply with me or help apply. We take individuals with any bachelor's degree in anything in business, economics, finance, architecture, real estate. If you come from that background, I'm sure I can explain to you a little bit more about the program itself. Something that Dr. B mentioned, we are ranked #1 in real estate in the US as far as real estate research, but we also are one of 4 universities in the US as RIC certified, along with Columbia University, University of Wisconsin, and NYU. So that puts us at a prestigious level, our program, compared to other ones in the US that offer real estate programs. We also have an advisory board that Dr. B has helped put together that helps with career development, along with partnerships with local and international and regional organizations that work with FIU. And we can also talk about the scholarships that MAR has in partnership with us that we can work with for any individuals who are looking for financial help. So like I said, I will put my contact information on the chat, and anyone who feels free or is interested in getting a master's degree in real estate, and I'll touch a little bit more into detail about it, I'll be more than happy to help them out with that. So thank you very much.
Thank you, Federico. I appreciate that. So let's jump right into it. I will introduce our first presenter. We're going to have 4 presenters. Each one will talk about a different topic. The first one is Mr. Adam Tiktin. And Mr. Tiktin has been an investment specialist for over 20 years. He mostly specialized in shopping centers, single tenant leased properties, and office buildings. Since forming his firm, Mr. Tiktin facilitated more than $1 billion in transactions and 400 commercial real estate transactions. Mr. Tiktin has tremendous experience and background in construction, development, finance, and accounting, which allow him to provide his clients with high level of expertise and advisory services. That's why he's been so successful. Mr. Tiktin also serves on the Hollo School of Real Estate Advisory Board. He is the head of its enrichment committee. He holds a Bachelor of Science in Management with accounting concentration from Tulane University. So without further ado, Mr. Tiktin, if you can begin your presentation. Thank you so much.
Of course. Thank you, Ellie. Wanted to start off by saying thank you to FIU's Hollo School of Real Estate. Thank you, Dr. Ali Beracha. It's a pleasure working with you again. And I'd also like to thank Paul with the Miami Association of Realtors and everybody else for joining us on this webinar. As Ellie mentioned, my name is Adam Tiktin. I'm the president and broker of Tiktin Real Estate Investment Services. We're based here in Miami, Florida. We do specialize in the sale of shopping centers in the state of Florida, single tenant net lease properties nationally, and office properties in the Tri-County area. We do investment sales only. We do not do any leasing, and we do not do any property management. We are a boutique firm that does institutional quality work. It's been a real pleasure working with FIU and Dr. Beracha, and we've actually got involved with the board of directors, the advisory board with the Hollo School about 1.5 years, 2 years ago. And one of the reasons that me and my firm wanted to get more involved with FIU is because, of course, it's the #1 real estate program in the United States. It's incredible what they're doing. And, Miami is growing. Miami, to me, is the best city in the world. I grew up here in Miami, so I'm a little bit biased. But also, one of the reasons that we got involved with FIU is because I really enjoy working with, helping, recruiting, and training younger people into commercial real estate and into the business. It's always a pleasure to help people launching into the career. It's a very exciting time, and the program, the master's program, is really incredible. So basically, one of the things that they asked me to talk about was the market, what's happening today. We are, of course, in the midst of a global pandemic, which has created a global financial crisis. The market's changed very fast. it looks completely different than it did back in February of 2020 this year. So here we are in August. We're getting to the tail end of the summer. As everybody at FIU and across the country knows that school is starting soon. There's a lot of challenges with getting the kids back to school and going back to work, opening up the universities. That's really a whole different topic, but that does have an impact on everything that we do as far as the economy goes, and of course, commercial real estate. So one of the things that Carlos with FIU asked is if we could put together some slides. We put together some information about what's happening in the market, and I'd like to talk about what's happening now, and also in comparison to what we experienced during the global financial crisis, which I'm sure many of us in the business will never forget. Back in 2008 and 2009, the crash. This one is very different. We're seeing some similarities, and so the slides we could touch on that, and also basically where we are and where we see things going. So Carlos, if you could put the slides up on the screen for everybody to see. It's a short presentation. We put together 7 slides, and here, this to me, this is a partnership. It's a partnership with our community. FIU's Hollo School of Real Estate and the Business School is very important to Miami and to all of us. And the Miami Association of Realtors, like Paul said, it's the largest association in the United States, which is incredible. And so it's basically a partnership between us and hopefully all of you to grow this community in a very positive way. So the next slide, we put together basically just some of our select currently exclusive listings that we put together. Again, as mentioned, we specialize in office properties, shopping centers, and retail. We do commercial property sales only. We don't do any residential. And this is just an example of some of the properties we currently have on the market for sale. Just for any of you who aren't familiar with our firm, Tiktin Real Estate, this is what we do. We've got an office property portfolio, which is a 3 office building portfolio that's available as a package. And also we just found out that it is also available separately. So we're working on that. We've got a shopping center, Town South Plaza, under contract. We've got a development opportunity, as you can see, in downtown Fort Lauderdale, which is very exciting. There's actually two buildings on that property now. There's a Sherwin-Williams on US 1, which is Federal Highway, North Federal Highway, and also the Greyhound bus station, but it's a high-rise zoning, so the developer who's under contract is going to redevelop the property. And a couple of other available listings. One is 1250 East Hallandale. Another one is an office building just east at 2100. And lastly, 1800 East Hallandale. So as you can see, we're doing quite a bit in Hallandale right now. And this one in 1800 East Hallandale, there's 2 buildings on that property as well. One of them is the U.S. Post Office, and one of them is a small office building. But Hallandale, the zoning allows to go up 350 feet or about 35 stories. And then we have a number of single tenant properties, like we have a Walgreens in North Carolina and AT&T in St. Louis, and so on. So next slide, please. Here we put together some information to show Florida, what's happening in Florida versus nationally. Florida is now the 3rd most populated state in the country. We actually just passed the state of New York about a year or 2 ago. We now have over 20 million people who live here, which is behind California, which has about 38 million people. And then Texas is number 2 with about 25 million. We're number 3 with 20 million. So, being in the South, being a very tax-friendly state, there's no state income taxes. A lot of people are moving here for the tax benefits and, of course, for the weather and the quality of life, which we hope to get back again as soon as this pandemic is behind us. So here, showing some of the current vacancies. In the second quarter versus the first quarter, which is what we put together here, the vacancies, we didn't see a lot of new vacancies. It just ticked up just a bit. You can see in Miami-Dade, Broward, and Palm Beach on the screen. And so we think that's really going to pick up here in the 3rd and 4th quarter. There's a lot of pain that a lot of people are feeling out there. Obviously, unfortunately, a lot of people are getting sick, and a lot of people are unemployed. But the retailers, there's been deferrals, there's been abatements, there's been credits because of the federal stimulus packages. They're working on a new package, which we think is going to be a lifeline to some of the retailers and office tenants, but a lot of them are not going to make it, unfortunately, and we're starting to see a lot of bankruptcies. We are starting to see a lot of distress. So the next part of that is the net absorption, which is in the middle of the page, and it's pretty incredible to see the differences there, and it is starting between the positive absorption in the first quarter in Miami and Palm Beach versus significant negative absorption, which again is leading to increased vacancies. Broward County was negative first quarter and second quarter, which obviously is going to impact, and this is for retail properties, this is going to impact the construction for this product type retail, which is really getting hurt. And they call it the Amazon effect, because obviously everybody can buy who has access to purchase online. And on the bottom, the last thing here is the cap rates, which we pick some select retailers, and cap rates for single tenants is the rate that somebody would receive as a return if they were to pay all cash on levered. And so you can see, for a triple net, which is no landlord responsibilities, double net, meaning there's usually roof and structure, or a ground lease is GL on the bottom right. So, and then lastly, you can see the number of sales. There's 128 sales in the first half of the year in Florida, and the cap rate and the rate of sales, the transactional velocity is definitely slowing down as we go further into this pandemic. Next slide. This is some national information, and I won't go into this too much, but it's really mirroring what's happening here in Florida. We are seeing people moving to Florida from other states like New York, New Jersey, Chicago, because of the tax advantages and quality of life. So we're seeing more trades here than other places, because people typically like to see the real estate that they're buying or be closer to it if possible. And so the cap rates are going up because of the risk that's perceived. And so we have national cap rates versus properties that are on the market and what's happening to those. So we'll move ahead a little quicker. The next slide, please. This one, I don't know how well you can see it on the screen. The numbers are smaller. I'll just speak to it. And if anybody would like me to email this presentation afterwards, I'd be happy to do that. Here, what we did is we've got stock and velocity, which we track the amount of properties in the market and what the number of properties that actually trade. Here you can see this is Miami-Dade County only. And so I'm going to turn to that page so that I can speak to it. And we've got Florida next. But what this slide speaks to is that in Miami-Dade County, there is 5,189 single tenant properties, single tenants like a McDonald's, a Chase Bank, an Advanced Auto Parts, Taco Bell, and there's 5,363 multi-tenant shopping centers in Dade County. And so we're showing on this slide the sales between the first quarter and the second quarter. We're definitely seeing the velocity slowing down of transactional activity. And we're also showing the trailing 12 months from 2019 through June 2019 through June 2020. And to give you an example, for single tenant properties, there was 211 properties sold in the 12 months through June 2019. This year there was 150, and that's in the 1 to 10,000 square foot range. So a significant drop off on the amount of sales, and a lot of that is because of the capital markets, and we'll possibly talk about that here in a little bit later in the into the webinar. The next slide, which is our last slide, this is talking about Florida and very similar trends across the state of Florida. There's 52,020 single tenant properties in the state of Florida, and there's 39,000 shopping centers, open air centers, and malls. So altogether, there's just shy of 100,000 properties in Florida, and this is retail properties only. So, and then the same thing for the transactional velocity. So basically it gives everybody a snapshot as to what's happened and what's happening. The next slide will finish the presentation, and then I'll just have a few more words after that before we pass it on to the next person. The last slide, Carlos. So this is just, we're going to have, as Paul mentioned, we're going to have some questions and answers later in the presentation, but this concludes the slides that I put together. And so just a couple thoughts that I wanted to mention before finishing up. again, nobody saw this pandemic coming. It has turned into a global financial crisis. And so this is a cyclical business, as we all know. Everybody knew that there was going to be something that was going to have a negative impact on the market. For 11 years, it was the longest economic expansion in US history. There was 44 quarters of economic expansion. It was only a matter of time. And so now we're seeing this crash, which was again caused by the pandemic. And so we think that there's going to be distress in the next 6 to 12 months, and also in the 12 months beyond that. We do think South Florida is resilient. We think a lot of people are going to move here. We definitely think the prices are going to be higher in 10 years from now than they are today. But we do think in the next 2 to 3 years, we're going to see prices decrease before they go back up again. And so the last thing that I wanted to add is that my firm, we did plan for a downturn. We certainly didn't see a pandemic coming, but we did think that the market was very expensive in 2019. We planned for it. We didn't hire too much towards the end of 2018 and 2019, but we are actually starting to hire again. And we've recently hired an FIU graduate, and we're very interested in working with FIU and the MSIRE graduates. And so we are looking for talent, and we're growing the firm, and we're looking forward to getting through this cycle and on to the next one. Thank you. Ali, back to you.
Okay, thank you, Adam. That was informative. And like we said before, we will, by the time we finish with all the 4 presentations, we'll open it to the crowd for some Q&A. So let me introduce our second speaker. And the second speaker will be speaking about the luxury real estate sector, which we have a lot of that in Miami. That's part of the lifestyle here. So her name is Mr. Alexandra Goeseke, Miss Alexandra Goeseke. Ms. Alexandra Goeseke represents a unique combination of first-hand experience, next-gen ingenuity, and textbook education that is driving the future of one of Miami's most influential real estate brokerage firms. She joined Cervera Real Estate in 2007, and at 30 years of age, she has already successfully managed and sold out 2 luxury high-rises, accomplished record-breaking sales, and contributed to the firm's global expansion through a partnership with Manhattan-based Stribling and Associates. Ms. Goeseke is a member of the Hollo School of Real Estate Council and holds an MSIRE degree from FIU, as well as a master's in real estate development from Columbia University. So please take the stage.
Well, thank you, Ellie. So I'm an undergrad and graduate of FIU, and similar to Adam, we just actually hired someone from the master's program at FIU to start, and I'm a big proponent in endorsing our community and hiring the great talent that we have here. So Carlos, if you can start the presentation, please. So I'm going to be giving you a luxury real estate market overview. Next slide. Some of the key topics we're going to be addressing is our background and our specialty, as well as new development, construction, secondary market, the challenges. Next slide. Next slide. So Cervera Real Estate was founded in 1969. Our niche was started by my grandmother in finding to exclusively represent developers for their sales to do the sales and marketing. And in that, we have been involved in over 115 projects. Actually, Ellie, next slide. Carlos, next slide, sorry. We've done over 115 projects that we've represented for the developers, 60,000 plus condos, over 16 billion in sales, more than 2,000 rental condos on an annual basis. And alongside with our developers, we've been known to help revitalize neighborhoods and create a vision to make the success of everything. And often what makes Miami successful is selling our lifestyle. We have grown to be established. People say New York, but we always have to sell Miami in our community. It's not only just the condo. Next slide. So going into development sales and the state of the market, because I'm sure everyone's curious to know what's going on with all the cranes up. So one of the projects that we represent is Nadivo in Miami. It's currently under construction. We have 50% under sold. We started selling the project a little bit about a year ago. And during the pandemic, we found an opportunity to honor the currency exchange rate that our international buyers had bought prior to COVID in order for the deposits to continue to happen. And what's unique about this product type is that it's a mixed-use development between office, condominium, and hotel. The units come turnkey, fully furnished. They have the ability to have a nightly, weekly, monthly, whatever kind of short-term rental accessibility. It's in the heart of downtown, just 2 blocks, I guess, west of American Airlines Arena. And in creating this, the vision of the developer was to offer housing for the passengers coming on the cruises and things like that. So when COVID and everything comes back to a new normal, as people say, we believe in the success of this project to adhere to both local and international markets. And since the pandemic, to know about the numbers, we've had 20 plus sales since the start. And we continue to have virtual interactions with our clients. Next slide. Okay. Aston Martin residence. As most of you have heard, you know, there's the Porsche residence, there's all these branded. Aston Martin, alongside with our developers, have created a very unique product where the Miami River meets the bay. It's adjacent to Epic. We have been under construction for more than a year. We have 60% sold, which is about $500 million in dollars sold. And just to give you a comparison to how Miami has grown and evolved in price points, we sold Epic and we completed the project in the middle of the financial crisis. That sellout was a little bit over $350 million and about 350 plus residents. Aston Martin's slightly larger, and it's over $1 billion sellout. So you can see within over 10 plus decade, the growth in the price point in the community and how we're growing to the next level. And since the pandemic, we've had about 3 sales per month averaging. Next slide. The Conrad, the Ocean project in Fort Lauderdale. It's an existing product already. We've had it open for a little bit over a year. It's a hotel condo component. You can either put it in the hotel portion or keep it for yourself. And one of the unique products that the developer is offering is a leaseback program as an incentive to motivate buyers. This project has been one of my most successful in terms of Zoom webinars, of which at Cervera we started over 18 months ago. And we've had over 10 plus sales just on these platforms as such we're doing now. And during the pandemic, we've had 1 sale via Zoom versus in-house one-to-one private sessions. Next slide. So Cervera is primarily known for doing residential, but we often get called to do commercial. We've sold the land for the Four Seasons in Brickell. We've put together some deals. We've done some retail restaurants, and we have 2 office projects in Adventura. Our latest is 1212 Adventura on 214th Street and Biscayne Boulevard. And the unique product of why we chose to work alongside with the developers that this is within the Adventura Health District. So therefore, if there's a doctor that's wanting to come and open an office in a nice, modern, contemporary building, which in Adventura isn't as common, even though in the last couple of years, there has been an increase in office buildings being done. We have 31 offices available, of which, well, not available technically, we're 40% sold. We broke ground exactly March 15th, a week before COVID happened, and we are still moving forward and it's a unique product. We have 4-story buildings. It's very boutique. It might fit now with the ever-changing of less human interaction with the pandemic. So I welcome you all to get to know it. Next slide. And just when the world thinks that we're coming to a stop in Miami and that there's not going to be any new developments or anything, we're launching the Markers in Grovile. It's an ultra luxury boutique building of just a little bit over 70 residents, all with waterfront views. And that's launching later this month. So just stay tuned. Next slide. So to give you an idea of where we stand in terms of new condo construction developments, we have over 90% sold. And I'm talking about not only our projects across the board in Miami-Dade of the developments in the pipeline. And we have about 1,600 units remaining to be sold. And it's a combination of projects that have already been delivered, and there's a remaining 10% or 5% of the inventory, with a combination of projects that are still in the pipeline. So during the financial recession, the remaining inventory was far larger than it is compared now. So it shows a healthy market for the developments that are being completed now or will be turned in the next 24 months. And they're deposit heavy, so we feel strongly that they will come to a closure, we'll be able to turn it in, and it doesn't look as scary with all the cranes being constructed. And next slide. So thank you to Craig from ISG, who was providing the data. If you haven't seen his summer 2020 report or webinar, I highly encourage you to do it. He's been doing it for a long time. His statistics are phenomenal, and it gives us a very good scope of where we are in the market. So you can see that the blended average for projects sold is between 80 to 90% in Brickell and downtown, which is the heaviest concentration of projects coming into the pipeline. So we see that as a good sign for things moving forward. Yes, there might be a slowdown, but in terms of the developments that are being built, they're cash, they're moving forward. We feel strongly that it will do well. Next slide. So now to talk about the secondary market, which we call general real estate, at least internally at Cervera. So some of the real estate trends that we've been seeing is, at least from our firm, we've seen a 30% increase in our transactions in rentals since the pandemic. So we feel that there will be coming more rentals. The problem is that there isn't enough supply for the demand, at least from our perspective. Everyone's heard that the single family home housing market is booming. That's no news. But to take a look at the caliber of the ultra luxury that's coming in, Key Biscayne waterfront homes has had a 180-degree shift in sales. From September to March of last year, from September 2019 to March of 2020, there was 0 waterfront home sales. From March of this year to July, there's been 7. So there's been a total increase. The buyers, it's a capital flight from tax burden states, like Adam said. Very interesting, there was some buyers from Irvine, California, which is unusual to see in Key Biscayne. I would have imagined maybe more South Beach, but you see this shift of quality life and not wanting to pay the taxes. As I always tell them, you're welcome to come to the state, but leave your politics in your own country or state. Next slide, please. So just to give you a breakdown of how the absorption rate is going on in the single family home, there's less than 1% of inventory available. It's just impossible to find, especially if you're looking at the Coconut Grove market for a high-end rental home. There's very little, there's less than 10%, even 5%, and they go quickly. So there's an opportunity there to try to capture more in the single family home. It's totally a seller's market. There's a limited amount. even less since March, that number significantly decreased. And also in Broward as well as Palm Beach. Next slide. So I put a comparison here, single family home versus condo, to get an idea. As we know, there's an increasing amount of sales in single family home as well as in renters, total sellers market. Now in the condominium, before the pandemic, we had a decrease in supply. Since the pandemic, we've had an increase in supply and a decrease in demand. So it's a buyer's market. We like to call it a doer's market because we feel that there's opportunities to be had for those who know that the long-term effect of the condo is going to be a great gain. People are hesitant right now because of the limited amenities and the restricted accesses, but as we know, the Americans as well as the Europeans and the Chinese are all working to find a vaccine for this COVID. So this is going to be a short-term situation for a long-term outcome. So I welcome you to look into these in the secondary condo markets because there are deals to be had, and think of what to offer to your client that's different from the typical. And just so on a monthly basis, the absorption rate is about 2,700 units. Next slide. So this is a snapshot of seeing where the biggest demand in the trading's been going. So over 55% of the transactions, about 1 out of 3 sales are coming from Brickell. Next slide. So where are the buyers coming from? We've always been very foreign buyer development, but what we've been seeing is since the pandemic, a very large increase in domestic shift. Like Adam was speaking about the population shift coming to Florida. And then also, which has been a lovely surprise, has been local buyers who have been coming to purchase because of the all-time low interest rates. So we've been working with different plans on how to offer these services to structure our buyers to get the loans that they need in order to buy first-time homes. So we've been seeing that of which we had in 2004. Next slide. Okay, so the population, similar to what Adam spoke. So ISG has been doing a great job of tracking as well with the census in the last 2 years. If you haven't put in your census 2020, I encourage you to do it. It's very good for endorsement for school funding in your area, the construction, the infrastructure, so please go ahead and do so. But looking, Florida's had a daily increase, unlike Connecticut, Boston, New Jersey, Chicago, New York, has all had a significant increase. You know, the New Yorkers constantly say that Miami's a fire sale. Well, I caution them in the wind about the future of their city. Next slide. Now, what you can see on the right-hand side, the pie charts, it's very interesting. 10 years ago, most of our population was coming from Latin America. Now, current year, in the last year, it's been domestic, over 52%, which has been unusual. So I feel like Miami's finally arrived where the Americans can see us as an established city to build their homes and invest their companies and their time and make us even better than we already are. Next. Okay, talk about the challenges, because obviously everything isn't all green and happy. Challenges that we face, especially in the secondary market, is buyers can't physically go see the location. Some of them can't travel because of certain restrictions. So we're forced to see other ways of how to keep the market going. Condominiums have restricted or eliminated amenities, and buyers favoring single family homes over condos. Next slide. Certain things that we've been doing at a firm. So Zoom, we've started using this platform over 18 months ago to do a lot of our international buyers and relations with brokers to talk about our development products that we have and to kind of do preliminary before we traveled. Our firm was traveling at least once a month to different parts of the world to sell Miami. So we've now implemented all of that Zoom technology, video conferencing, interactive AI videos to do for the general real estate, the secondary market. One of the things, like Adam was saying, we've hired a couple people since the pandemic to grow and be more effective in the firm. And one of the opportunities is that we're rolling out a new CRM platform that's highly interactive for virtual presentations. So if you want to be different in the market, I welcome you to do that as well. Next slide. So next slide. So key drivers, like we talked about, the tax refugees. Now there's been a need to diversify investments. What we've been seeing, at least in the luxury real estate, is our clients calling saying, well, we've bought the house, we've bought the apartment. What do we do, thinking of our long-term stability plan to grow a portfolio of assets that help us have some sense of security outside of these non-tangible, intangible assets. So we've been working with, like I said, going to the condo market, seeing what's available, what kind of duplexes, multifamily offices I see will continue to still be a strong driver in the community, even though everyone's working from home like I am today. But I don't think that offices will vanish. Retail with its time will figure out a solution to the Amazon effect. And so we're working with different ideas of how to grow these individual family funds for our clients. And historically, Miami condos have been proven to be a long-term solid purchase. Miami condo prices have appreciated over 200% since 1995. Next slide. So one of the unique opportunities I forgot to mention is of what our developers are doing. Aston Martin is rolling out a seller financing program on the deposit with a loan to value of 70 to 30. So the buyers put down a 15% and the developer finances the remaining balance of the 15% at an interest rate of 7%. And then when they come to closing, the buyers can either pay off the balance or take on the loan right at closing. So that offers a different structure for buyers who don't want to tie up their money for 2 years for 30% of that. Key takeaways. It's a totally a doer's market. People are willing to negotiate. There's less stubbornness of, I want the highest and the best price. There's more of a well-priced market. Buyers are looking to diversify their money, how to do it, where to do it, long-term goals versus short-term goals. How can we use the dollar more effectively? And COVID has impacted us, but not in a negative way. It's given us a reason to find a solution, to get creative, and to stay on top. Continued population growth, declining supply, and we're the US. We bounce back first, and we're here to stay. And with that, everyone else will follow. Thank you.
Thank you, Alexandra. That was a very nice presentation, very informative. I saw some questions on the discussion, if we'll provide the slides and recording. So I believe the answer is yes. Carlos will follow up, but I believe that we will be able to provide a recording of this webinar. And also, if the panelists will allow us, we'll also share their slides. We need to ask their permission, but as long as we have their approval, we'll do that. So let me take now on our third presenter. And our third presenter is Miss Wesley Ulloa. And Miss Ulloa is the broker and owner of LUXE Properties, LLC, an investor and business sales coach with 15 years of experience in South Florida real estate. Wesley started her real estate career at Fortune International Realty and founded LUXE in 2014. LUXE Properties has recently surpassed 300 productive realtors. Her success as a founder of LUXE Properties has given her deep knowledge and understanding on how to guide and educate real estate agents in becoming top producers, and she's prepared to lead her brokerage firm to the next level. Ms. Ulloa is a member of the Hollo School of Real Estate Council and active in numerous organizations, including serving as the president of Miami YPN. She holds, of course, that's why she's so successful, or at least partially, an MSA degree. She was one of my students. So yes, she has her master's from FIU. And Wesley, please take over. Thank you so much for agreeing to present with us.
Hey everyone, good morning, almost good afternoon. Thank you all for attending, and I really want to say thank you, Ellie, and of course Paul from Miami Association of Realtors. I attribute a lot of my success in my career to having my master's degree at FIU, and I highly recommend that anybody is interested, look into it, and as well as serving with the Miami Association of Realtors. So I've learned a lot throughout the years working together, and I'm happy to see us all collaborating. I would love for Carlos to put up my slides if he doesn't mind. Thank you. Okay, so I'm gonna take you through a current inventory of the resale market. And what I wanna take a look at is where we were pre-pandemic and what has transpired since then, right? We are noticing a lot of trends emerge from this pandemic. So I wanna go through that with everybody here today. Can I get the next slide, please? Little bit about myself. I was born and raised in Miami. My firm is LUXE Properties. We started in 2013. We now have over 340 agents. We primarily focus on residential resales, very heavy in the single family sector. I've been practicing 14 years licensed, 15 years I started under a developer, do have my master's in real estate, and I was a 2019 YPN president with Miami Association of Realtors. Next slide, please. So, want to go over a few trends with you guys that we're starting to see emerge in 2020. Most importantly, of course, in this coronavirus era, it's the virtual agent and the entire real estate experience. We have completely transitioned to going virtual. We are selling properties through videos, Matterport. We have several properties under contract from individuals from these heavy tax states that they are signing contracts without even viewing properties, just through video tours. So what we have begun leveraging is each one of our properties that we list and market has a full video tour and Matterport tour, which is really accelerating our velocity of sales and helping out. A really big trend, of course, you guys have already heard of it a few times, but we're getting a huge influx of the Northeast, a lot of individuals now, even from California as well. And we're starting to see a lot of these people mainly look in the Miami or Broward area, but a lot of them are headed to single family homes. In a few slides, I'm gonna go over what is happening, and we're seeing a big divergence in the single family sector versus the condo sector. A lot of individuals are looking for more bang for their buck. They'll work from home. They want the larger space, the office, the yard. They don't want to live in these high density areas. So our single family sector is performing extremely well. I've been practicing now for 14 years, and in the single family sector, I haven't seen anything like this. Another big trend, scarcity of homes and affordable price points. We do not have enough inventory. We cannot keep up with demand in certain segments. We need new construction as soon as possible because we are literally running out of inventory, in the easiest way to say it. Another thing is low interest rates. We have record low interest rates. I read this morning that we broke another record. It's going to be interesting how this is going to play out over the next 12 months, and we'll talk a little bit about that too, considering that this is an election year. Can we go to the next slide, please? So I created a few graphs for you guys. I got this information from Miami Association of Realtors, the MLS, and Trend Graphics, showing us, and I just wanted to show what has transpired over the last year in each segment, right? So we had a high of closed sale transactions in single family residences up to 500,000 back in August of last year. Since then, and I would say because of inventory reasons, we have not hit that level again. Now in March, you know, considering that this is a seasonal industry, in March we had 892 sales. But because of coronavirus, May we bottomed out. You know, March was the time period that everybody kind of put a pause on signing these new contracts in mid-April. Once we started getting a better hold of things, it was about a 45-day period, we started seeing a lot more contract signings. We did have a 36% drop in closings from March to May, but we have rebounded, but we have not been able to surpass that number. Now I'm going to show you what's happening in the segment above 500,000. This is completely due to a lack of inventory. If we could go to my next slide, please. We only have 1.8 months of inventory currently right now in the single family sector. So that is an extreme, I want to say pretty much in what I'm seeing, an extreme undersupply. Day in and day out, any property that we are listing below 500,000 has multiple offer scenarios. We literally have open houses that have 40 parties waiting outside to come inside. We're seeing individuals pay over appraised value, waiving contingencies. We literally signed a contract last week that had no contingencies at all. Nothing. They just want, of course, title, but inspection, everything else, they are waiving every other major contingency. So this is going to be interesting to see how it plays out, because if things continue, we're just going to continue to see a big increase in prices, which we are already seeing. So our appraisals are a big issue day in and day out, because they are coming in lower. At least in this sector, because you're seeing so much demand fueled by low interest rates. Now, can we go to the next slide, please? So here, this is why I want to show you why it's because of inventory. Here we have the closed sales from $500,000 to $1 million, right? So we had a 35% single family residences, I'm sorry. We had a 35% drop here from March to May. And we've already rebounded and surpassed those numbers. We had 276 closed transactions in July. And I also like to note that we're still getting reports in from our closings from July, but I want to show you how strong this segment is performing. We've always had more inventory in this price point from 500 to $1 million. So that's why you're able to see this increase from August of last year to now. If we could go to the next slide. We have also seen inventory get scooped up relatively fast in this segment. We do not have as many multiple offer scenarios, but if the property is priced right and shows well, especially the properties that are doing extremely well in this market are the ones that don't require much work, right? Individuals are looking for something easier under the coronavirus era, but you're still seeing the same trends here. I did not include over $1 million because Alexandra was covering luxury, but we're seeing the same thing in that segment as well. Our rate of sales for anything over $1 million has also surpassed 2019 levels across the board. So every single sector in the single family market is doing well. And I only attribute the below 500. The reason why we have not surpassed those numbers is just because we don't have the inventory. So that's our single family market. Now I'm going to start going into the condo market. And you're going to see some similarities here with our peak and our bottom because of coronavirus. But we experienced a 52% drop in closed sales from condos up to $500,000. But what we also have seen is we have not risen or we have not matched our pre-pandemic levels, right? We're seeing a lot of these condo owners or a lot of these renters or a lot of these individuals who live in these high density areas, they want single family homes. Majority of our sales for single family homes that are not coming from, let's say, the Northeast or other states, A lot of these individuals are looking for properties, are living in condos. And you're also getting a lot of move-up buyers, individuals that are selling their home and they want more space because they've had to change their lifestyles. I think this trend is going to continue as well. As long as we have working from home, I think companies are now adjusting to this, and this is always going to be some segment or some part of the work experience. So the bigger home is starting to seem more appealing, and the city or the walkability or the lifestyle, at least in the era that we're in, is not as attractive. You can't necessarily go to all the shops and the stores and the restaurants or live the same lifestyle that you would have in the city. Now let's go to months supply in condos up to 500,000. And you will see that it has improved here as well. There's a mix here, right? You do have some affordability with townhouses, with townhouses mixed in with this data, so that could also be a big trend here. But it has rebounded quite well since the May drop from here. Now, once you start looking at luxury condos, which is my next slide, you also see the same trend. We had a 61% drop here during coronavirus, has not rebounded. And if you go to my next slide, you will also see that the month supply, while it has improved, we still have a 34-month supply of condos above 500,000. That number balloons even higher if you look above the $1 million mark. There is still demand, but we are seeing a really big shift towards the single family market. And condos have not rebounded as strong as the single family segment has. So if we could go to the next slide. So looking down the road and some key takeaways that I want to discuss with you guys. Working class and the rental market. So we're definitely seeing a trend, and the segment that has been affected the most in this coronavirus pandemic has definitely been the working class, the individuals that work in the travel industry or leisure or hospitality. So those individuals have typically been in the rental market. It's going to be interesting to see if rentals are going to go down in the everyday rental market, not the luxury rental market. I'm on the side that believes that we're going to see a decrease in rental rates across the board. So is that going to affect pricing down the road? Typically, the blue collar jobs are the ones having more trouble right now, whereas the rest of the working class is doing very well. So that's why we have not seen any difficulty whatsoever during this pandemic. But we do definitely have an inventory shortage, and you are seeing a divide amongst, the wealth gap. So we have a problem with affordable housing here. That's already was prior to the pandemic a situation, and I think it's just going to be accelerated due to the pandemic. Working from home is going to be a big trend that's going to continue. I think we've all got quite comfortable in some cases working from home, and I think a lot of companies, there's many companies that have already said that they plan on having their employees work from home through August 2021. So interesting to see how companies are going to adapt. Definitely homeowners or individuals purchasing properties are looking for that extra space, that home office, that pool home as well. So we're seeing a lot of the demand in those. Down the road, things that we do have to consider, of course, is climate change. I already mentioned the income divide. And us as real estate agents or any agents that are on this call, we definitely have to keep innovating. There's many disruptors in this market. And now that things are going very virtual, we have to be ahead of the curve when it comes to that. Our consumers are expecting more of us, expecting us to be more of an advisor, not just somebody who opens doors. So that's where I see us transitioning and making sure we have well-rounded agents that could support these individuals who expect more from us day to day. So that should kind of give you an overview of what's happening in the residential resale market. My next slide is just my information. If you guys have any questions whatsoever, feel free to reach out to me. And once again, thank you, Ellie and Paul, for having me on this presentation.
Thank you, Wesley. That was wonderful. Wesley and I actually had a conversation just, maybe a week ago, and we're talking about, how difficult it is to actually find inventory to sell. I think personally, I'm not presenting today, so I'll not dive too deep into my opinion, but, it is probably part of individuals that are seeking some kind of a safety and security in those very uncertain times, in addition to the pent-up demand that we had in the months that people did not buy houses, March, April, maybe even May, and they kind of buying them now. So hopefully good things will come out of that and will not be falling by a crash like we did in 2009. Okay, so let's continue with our fourth and last presenter. And our fourth presenter will be talking about the office market. His name is Mr. Jonathan Lay. Mr. Lay is a senior associate at Fairchild Partners and has nearly 15 years of real estate experience in South Florida's real estate industry. Mr. Lay supports the firm's agency and tenant representation, as well as property acquisition and disposition arm, with a focus on office and industrial properties. His experience and background allow him to create a comprehensive solution for his clients by providing market and financial analysis, transaction structuring, and strategic planning throughout the entire real estate transaction process. Mr. Jonathan Lay is a member of the Hollo School of Real Estate Council, and of course, again, contribution to his success, he holds an MSA degree from FIU. In 2016, he was named one of the 10 most influential MSRE graduates. So Jonathan, please take over. Thank you again for agreeing to present with us.
My pleasure. It's always nice to see you guys. Real quick, one thing I'd like to add, I definitely contribute my success in real estate to the degrees I've obtained at FIU. It was really the background, the foundation of, I feel, what was needed to have a successful career in real estate, whether leasing or capital markets. I'd like to go ahead and, Carlos, if you could please put up the slide. I would like to just give a quick background on kind of where the Florida was entering into 2020. It was a very positive outlook. You can proceed to the next slide, please. We had a real positive outlook for the year, still seeing a lot of leasing activity going on. We started with about a 3.3% unemployment rate. 2019 job growth was at 2.5%, with still a strong projection for 2020 at 1.9%. Miami and specifically achieved close to 5% job growth year over year from September 18 to September 19. So everything really looked good coming into the year. And of course, now we fast forward to June after the COVID outbreak has happened. Unemployment showing a 10.4% as of currently. August 21, we have our next reading. That's projected to go up. And again, I feel that number will go up once stimulus dollars are all exhausted. And the performance of the company will actually determine if they can pay rent or not. Moving on to the next slide, please. Quick snapshot on the Miami-Dade office market. We have about 109 million square feet in our market, slight increase from last year. Currently under construction, we have 3.8 million square feet, which is about a 30% uptick from last year, which is equivalent to 3% of our current inventory. To make note of some of these projects here, you'll see on the screen, 830 Brickell Plaza. It's a 650,000 square foot building. They have done some pre-leasing in 2019 to WeWorks, who's committed to take about 147,000 square feet, or more, about 22% of the building. They're projecting $74 per square foot on a full service basis for that market, which would be a ceiling. Currently, you're seeing rates in the 1450 building, the nicer buildings on Brickell in the 60s, mid to high 60s. So this will be a market new. Second largest building that's currently under construction. We really don't track it because it's a corporate office for Royal Caribbean. It's being built on Terminal Island. They have about 350,000 square feet. Until they start offering space to the market and competing with these multi-tenant buildings, it's kind of, we track it, but it's not a main competitor for us. Moving over to Wynwood, we have 545 Wynwood, about 200 99,000 square feet that's being delivered at the end of this summer. They are just about at 5.5% leased and trying to achieve $60 per square foot on a full service basis. So that building definitely has some work ahead of it as far as occupancy. And then the third building, moving out west to Coral Gables, we have the Plaza at Coral Gables, which is about 292,000 square feet. That's being delivered at the end of this summer as well. They only have about 10% pre-leased, and they're trying to achieve $55 to $62 per square foot on a full service basis. So real high numbers. We'll see how that comes into play when everything starts to settle down at the end of this year and beginning of next year. But another thing to point out, in the next few quarters, we are going to have 1.4 million square feet delivered. Of that, they're showing 60% that's still vacant. But in reality, if we net out the single tenant buildings like the Royal Caribbean Corporate Center, that 60% is going to increase substantially. So definitely tenants are going to have more options when it comes to new product in the next few quarters. If you could please proceed to the next slide. On the leasing side, looking at Miami-Dade County, we saw a little uptick in vacancies to about 9.5%, but that's one that towards the end of the year, we'll be able to get a better understanding of where that number's at. Currently, we're seeing in our firm probably 40% of the transactions we were seeing pre-COVID. A lot of those, decisions are being put on hold. Average rental rates, again, currently at $39. That was an increase from last year. We foresee that at some point having negative pressure with the increase of vacancies, that will end up going down. But I have to say, currently, landlords are really not reacting as far as reducing rates right away. What we're working with is more concessions and helping tenants get beyond this period of uncertainty. Please proceed to the next slide. I'm not going to spend too much time because Mr. Tiktin did a great job on the capital market side, but just here focusing on Miami-Dade County. In 2019, we saw $1 billion in sales. We're currently about at 40% year to quarter, about 400 million. And to make note, the majority of that number is a sale that happened in July. 2 and 3 Brickell City Centers sold for 163 million, which translated to about $630 per square foot. So that is definitely a very high transaction, and we have to see if that's going to continue on. I don't believe we're going to have much activity, especially in the office side where there's still a lot of uncertainty whether tenants are going to make it, which creates a nightmare when underwriting these assets. Real quick, I read a report from CBRE. In the Americas, we're down about 70% in investment sales, and globally it's down about 57%. So we're definitely seeing a decrease in sales. Please proceed to the next slide. So this is where it gets a little more interesting. So in forecasting for 2020, we already knew that we were going to have less activity than 2019. We're coming off a very strong 10-year cycle. We started to see a decrease in activity. On top of that, being an election year, you tend to have a decrease in decision making. So any decisions that need to be made tend to get pushed out, or tenants will wait to see if they need to expand or not. So when you add, coming off of the 10-year cycle with an election year, we expected low absorption. And then we put in COVID, right, into the mix. So that really changed everything for us on the office side come February, March. Current market really doesn't reflect the whole picture, as Mr. Tiktin mentioned. There's still a lot of stimulus dollars that are being utilized to pay rents. Tenants are going to landlords to get some immediate rent deferment to get through this situation, or the immediate situation. So really towards the end of this year, first quarter of 2021, we're really going to be able to see which tenants were able to make it or not. I'm starting to see a slight uptick in subleases in the market, more from larger corporations that it seems like they're looking to let out some space. But again, nothing really happening on the rental side. We're really not reacting as far as rates when it comes to the market. Another big thing that we're faced with was the non-essential businesses being closed and the schools being closed. That created this new culture, this work from home culture, where people in 24 hours or 48 hours really had to adapt to working from home. A lot of companies have had success, as was mentioned. I don't foresee this holding. Maybe we'll go to 5-10% of the employees that have the ability to have the flex schedule, but all the tenants we talk to, they want to be back in the office. We're social beings. They want to interact with their teammates. When it comes to hiring, now it's not necessarily a big issue because everybody's working with what they got, trying to get by. But when you have to grow your team and expand your company, hands-on training, we feel, is number one. So maybe in the next 3-4 quarters, we'll see this trend continuing, but at some point we feel we'll get them back into the office space. Definitely have a lot of ongoing concerns for these employees at the buildings. The landlords that we work with are really doing a lot to try to offset these concerns and make them feel comfortable in coming back into the office. Some of those would be, higher janitorial services, cleaning of high touch point areas more often, upgrading of air filters, following CDC guidelines when it comes to social distancing, elevators, how they're being utilized, limiting the passengers going up and down, and really just an effort to make tenants feel comfortable and have them come back into the office with less concerns. Currently, we're seeing about 25 to 30% of our tenants coming into the office. The majority of those tenants are client interface where they have to meet with clients. If it's a company that was a back office or a call center, we still see them working from home. And I've noticed the more corporate companies are being a little more lenient to allow employees to work from home. And again, some of those, as was mentioned, they're pushing that out to Q1 of 2021 to see where we're at. So it's an ongoing battle to make the tenants feel comfortable, get them back into the office. And then a bigger negative pressure on that would be the schooling. If you have a household with 2 parents working, it's very difficult to find accommodation for the kids and to be able to get back into the office. So until we really have a better understanding of when school will be starting and kids get back to school, that's going to negatively affect the office properties. One thing we're doing to help offset some of these challenges and concerns when new prospects are coming to the building, we've moved to completely virtual touring of the space online. And then when it comes time to actually the tenant coming by the property to see it, it's kind of like a touchless tour process. We have doors open, lights on. They really just need to walk in the space, walk out, and don't have to touch any of the surfaces. So it's helping out with them feeling a little more comfortable, seeing what the landlords are doing in an effort to make them feel comfortable getting back to work. One thing we're doing with existing tenants or trying to attract new tenants, if it's an existing tenant that can really show difficulty that they're undergoing with the whole COVID issue, landlords are willing to give some type of rent deferment, maybe attach that rent towards the end of the lease term and give them 2-3 months of abatement up front. Another thing that in some cases you're hearing is that landlords are allowing tenants to apply security deposit to future rent payments to help with cash flow issues. So it's really an ongoing effort with landlords and tenants to work through this process together. I mean, it's not as easy as a landlord saying, yeah, just don't pay me. They have obligations with their debt providers as well. So it's not just, easy to just allow everybody to abate rent. With renewals, we have a lot of tenants that if they're coming up for renewals within this time, like in, your April, May, June, July months, they're really looking to, if they can, they'll push it 12 months if they feel strong about their company. But if there's a lot of uncertainties, they're just closing up and going from home. They're going to be working from home and then waiting for that next opportunity in 6 to 8 months when they have a clearer picture. And then also with the hopes that the market will soften and they'll be able to get more aggressive rates and terms. Some tenants that have not too much term left on their lease, if we're talking 2-3 years, we will early renew them and pump the concessions up front to help with this period. You really want to make sure your tenants are strong, because if you're giving them all these concessions up front and then in 5 months, obviously they don't make it, it was kind of wasted effort in that sense. And then with new tenants, that's very, very few tenants touring the market, especially on the office side. We do have some groups we're working with in the mortgage industry, insurance industry, who seem to be doing well, that are continuing to look for office space. The expectation, though, is to have some sort of concessions to help them get through this period of uncertainty. If they're willing to commit with us long-term, they're looking to, at this point, some tenants are pushing for concessions, Q4 2020, even Q1 2021, to kind of like get through this period. So it's really a unique situation in the sense that it's a deal by deal basis. It's not really kind of like a blanket box that they have to fit in. We're working with tenants because obviously some tenants are closing up offices, so our vacancy is increasing. And to offset that, we need to do creative deals with these tenants that are currently in the market. If you could please proceed to the next slide. And this is where it gets real hard, right? The market outlook. So Miami's global attraction and tax benefits, that's always been a benefit to us on the residential side as well as the office side, because these groups are moving and bringing their families here along with their businesses. So I think that does set us apart with the rest of the country. And Miami specifically, we have the Latin American influence. So we've definitely have a foot ahead of most cities within the US. And then of course, the need for office space. There's always going to need for office space, whether that work from home, stays for a while. And we do have some tenants working from home, social distancing and people wanting to feel more comfortable and more space between them is going to offset that. So I don't feel many companies are really going to contract or expand in that case, right? Because they will be allowing some of their tenants or some of their employees to work from home. Opportunities I foresee in this, going forward in this office market, definitely it's a time to meet with your tenants, re-strategize, see, what their needs are. I foresee contraction clauses in leases. That's something that wasn't typical. You really didn't see. It was only the right to expand, but I could see tenants taking a space, with the need today, but not sure what that need will be 2-3 years down the line, and potentially structuring deals with the landlord to an agreement to take back some of that space. As was mentioned, with uncertainty, increased risk, cap rates are going to go up. That's going to put a negative pressure on pricing, which creates opportunities for the investors. We're definitely seeing larger pools of assets, not necessarily on the office side yet. I think that's still to come, but you already see your distressed hotels and retail centers hitting. So to see if it translates on the office side, I think it will, but to what degree is still to be known. And then future challenges, a big challenge I see working closely with landlords over the last 5 years, tenants have been moving to a more open, less dense work area as far as offices to allow more bodies within the space. They've been putting pressure on our parking ratios. We've been building out these spaces more on an open basis, trying to outlive these tenants. And then I foresee that changing back now to the more individual offices, less open collaborative space. People are going to want their not privacy, but their safety, be able to close their door, maybe have an air purifier within their space. So I really see that, as a future challenge, and how these landlords are going to have to work to adapt these spaces, and not to say in, the next 3 to 5 years that will revert back as prices and rent goes up. The only way to really bring down your costs on a per employee basis is by getting more employees within the space. So I see that as a future challenge. For landlords, again, increasing operating costs to provide all these additional janitorial services, upgrading of filters, that's all going to increase our costs. The vacancies in the market, that's going to have a negative impact on pricing. So it's really eating away at the profit these potential landlords have. And office, it's always been very difficult to turn a profit in office, especially when you have such high costs when it comes to these improvements, tenant build outs. I don't foresee construction costs really going down. You would think there would be some type of correction, but we haven't really seen that yet. So, excuse me. So, and another thing, a point to make with this whole COVID thing, is this going to be a migration of tenants from the CBD moving out to our suburban office parks. The perception is these suburban office parks are a little safer when it comes to the whole COVID issue. We don't have structured parking garages where you have to get into an elevator with multiple people. It tends to be surface parking. Buildings are about 4 to 5 stories high. Tenants on the first and second floor could easily utilize elevators not to get into these confined elevator spaces, so which would limit the amount of people utilizing the elevators versus being on, your mainstream building in Coral Gables or downtown Miami, where you're parking on the 17th floor, you have to take an elevator down to the lobby and then an elevator up to your 50th floor space. The logistics of that is going to be very difficult as well. You think you're going to have to stagger start times, because if everybody shows up at 8 a.m. to access the building, you're going to have some wait time. So it's interesting to see how this is going to pan out. We definitely think there's opportunities with the increased cap rates and more distressed assets, specifically on the office side. If you have a building that is heavy on, you know, hospitality tenants or in the leisure industry, you know, they're going to take an effect. And then some future challenges, floor plan design mentioned, the operating costs, and then the big one would be the market uncertainty. Where's the market? If we continue to push these tenants 12 and 14 months down the line, how can we really stabilize our assets? So, and it's interesting to see how lenders are going to work with that. So pretty much done. If you would like to continue with the questions, I know we're getting close to 12:30. Any information that would need, you know, any additional questions, please feel free to reach out. I work closely with FIU and Miami Commercial as well, so anybody can put you in contact me if needed.
Okay, thank you so much, Jonathan. I really appreciate that. Again, another very informative presentation. We are getting close to 12:30. I'm willing to go maybe 5 minutes, you know, longer if our guests allow us to allow a few questions. So between Carlos and Paul, if you want to manage a few questions to our speakers, please.
Great. Thank you. Excellent presentations from everyone. We have several questions. We may not be able to get to all of them, but Carlos is going to unmute Joy Huang, that I think anyone can answer, but Alexandra or Wesley might be able to answer it on the residential side.
Hi guys, can you guys hear me okay?
Yes.
Okay, great. Thank you for the presentation. I really enjoyed everyone's presentation. I just have a question for, and maybe these are questions for Alexandra or Wesley. Where do you see the supply and demand in the single family home market in Miami in the next 6 months with PPP and unemployment coming to expirations? And also same question goes for the condo market.
I'll chime in really quick on the single family. I continue to see it decline. Even with PPP and all the other factors, I don't believe the everyday homeowner, it has been affected greatly by the pandemic. I really think it's been that rental class that I was discussing, that person who's renting property, not that person, the homeowner. And aside from that, I don't see a huge rise in foreclosures or short sales, just because, yes, some people will have to sell, there might be a rise, but if interest rates stay as low as they do, you're gonna still see that get scooped up, especially below the 500 price point. And a lot of people have equity. So I don't see a huge change in the marketplace unless something else happens.
From a single family and at $1.2 million plus, we see a demand that's going to increase. I don't see a negative downturn as a result. And for us, it's really a lack of supply for the demand. So that's something that we're seeing more of a change in. And in terms of condo, I think with time, people are going to start to realize the value of what it is to be in a condo again. Like I said, there's good deals to be had. The inflation rates that we're having from condos in the last 18 months are being suppressed to actually what it should be sold for, no longer, you know, seller's illusion. So I see that in 6 months, we'll see a growth in the condo market, at least in terms of absorption, maybe not on terms of price.
Got it. And for the sales during the pandemic, where's the majority of the capital coming from? Is it from, I know like it was previously mentioned like out of states, but are you also seeing foreign capitals as well?
I think she's asking, are you seeing money from Europe or Latin America? Has that shifted at all? Are we seeing any shifts in where the purchases are coming, especially internationally?
Oh, go ahead.
For us, I mean, the foreigners are still there, but it's been, domestic has been far larger, at least in terms of our buyers lately in our developments. It's been more domestic than actually international. So it's been a unique shift for us.
I would say the same. Lately, in the past month, I've actually seen a slight increase in foreigners touring our properties. But for the most part, it's been mainly domestic.
I'm going to ask this question, and this could be commercial or residential question, just as it's a simple question, but a great one by Nina Cardi on, are you seeing, what's the mix now of cash buyers? Has that changed at all? Are you seeing less or more cash buyers, both on the residential and commercial side? So maybe Adam?
Yeah, thanks, Paul. You're breaking up a little bit, but I did hear the question. That's okay. So as far as cash buyers, we're seeing a lot of cash buyers. I think for commercial, the financing is very different than residential. Residential, of course, the interest rates are very low, but for multi-tenant shopping centers and multi-tenant office properties, the rent rolls don't look like they did, and the balance sheets of some of these properties look different than they did. So the lenders are getting, very particular about the borrowers and the balance sheets of the borrowers. So the financing for commercial properties, it's still available, it's still out there, but it's not like it was in the beginning of the year before the pandemic. We are seeing cash buyers. As a matter of fact, we had a closing last week for a small office building at 1818 Sheridan. It was a 6,000 square foot office building that sold for $1,950,000. It was just over a 6 cap. It was actually a buyer from California who paid all cash, who wanted to start to purchase properties here in South Florida. So, we are seeing cash buyers. I would say that there's more cash buyers than maybe there was before the pandemic because financing is difficult. And again, there's not as many transactions, but there's definitely financing out there. But I would say cash buyers are going to be looking for opportunities.
I'm going to add on the residential side. So below 500,000, we're seeing more finance buyers, whereas as you get higher up in price points, you're seeing primarily cash, and cash is becoming more of the trend at the higher price points. But I will also add, a lot of people are trying to take advantage of the rates, but we are still seeing just a lot of the bidding wars. So we're having a mix in that. But a lot of people want to get a loan, but a lot of the higher price points are seeing the cash buyers come in.
On the commercial side, we're still seeing financing more SBA loans, but users of the property, right? Not investors. So they're going to be utilizing that space for their primary business.
And one thing to chime in, there's a lot of capital out there for both a commercial and residential perspective of people looking to buy. And in commercial, like the Swire office building is a great thing that they were able to time that in because they have great tenants. There's not enough quality inventory out there for these capital companies to come and purchase these assets that they want in REITs and institutional investments. So that's something we don't have enough of.
I think that's great. I think we're at 12:30 and we got some great questions in, Dr. Beracha. I'll just quickly thank all the speakers, which incredible presentations, a lot of great details in content that all the listeners got a chance to hear and see. And very excited, always excited about our partnership with FIU. And as I said, they're the #1 real estate school in the country. So congratulations to that honor, and it just continues to grow. I'm happy to hand it over to Dr. Beracha to end this. A great turnout today, and thank you.
Okay, thank you, Paul. Yes, I would just like to wrap up. Hopefully we'll continue and have more of those webinars in the coming weeks and months, and hopefully we'll transition to actual in-person events, or maybe some kind of hybrid between in-person and webinars. I'm sure that will be part of what we do in the future. I really do appreciate the time and the effort that our participants and panelists took in order to put together those wonderful, informative presentations. We are going to be getting their permission to hopefully sending those slides alongside with the recording of the presentation. So those that were registered and attended, or maybe could not attend live, will be able to watch it later. And until the next time, thank you for joining us. We'll see you virtually and in person, hopefully soon. Goodbye, everybody.